The government's borrowing program and how it will be front-loaded for the year FY13. Sameeran Chakravarti, who's the regional head of research India at Standard Chartered Bank, joins in for a quick perspective on this issue. Sameeran, great to have you on the show. First up, the government plans to borrow 3.7 lakh crores during the first half of FY13, which is 65% of the total annual borrowing program. The majority of the experts believe that the 10-year bond yields will remain firm over the year, with yields ranging anywhere between 8.5, 8.75 over the year. In fact, some believe that it may even cross 9%. What is your view on where bond yields would be headed?
Yeah, near term there are definitely pressures on the bond yields to move up, probably even test 865, 870 kind of levels as well. But two things we need to watch out for. One is that whether we see any kind of rate cut coming from RBI in the April policy, and second is that to support the borrowing program, do we see an RBI OMO as early as the first half of the year. So if these two things happen simultaneously, then possibly yields could head lower as well on support from these two factors.
Sameeran, hi, morning. After taking into account the redemptions during the first half of FY13, the net borrowing will stand at about 2.8 lakh crores, which is nearly about 50% higher than the net borrowing in FY2012. Majority of the experts, believe that the government, just like this fiscal FY12, that is, the government may end up borrowing more towards the end of FY13 as well. What is your view on this?
Yeah, again, what we need to distinguish here is that it's unlikely that the government will slip as much as last year. Yes, we also anticipate that possibly anywhere between 20,000 crores to 40,000 crores of slippage could come over the full year. But since it's much lower than last year, we would think that the slippage will not be visible in the first half of the borrowing. It will, if at all, figure in the second half. That's one point. The other point is that government has this time budgeted very little on the small savings number and very little from the T-bill side. So last year we have seen 1 lakh crore of net T-bill issuance vis-a-vis this year's target of just 9,000 crore. So there is some cushion left to fund any slippage on the fiscal through either the small savings or the T-bills. So the net GSEC issuance might not go up substantially because of these two comforting factors.
Where do things stand then as far as a schedule for rate cuts is concerned? Because, with this extensive borrowing program, you're going to be looking at inflationary pressures coming into the system. Do you think that the chances of a rate cut in the April policy are now lower and the central bank will perhaps rethink its decision to actually go ahead with a rate cut as soon as a month's time?
Yeah, I have been maintaining this for a while that April rate cut is not a done deal. What the central bank would be kind of the dilemma is that if they look at the current rate of core inflation, then that's much lower, about 300-350 basis points lower than what it used to be 3-4 months back. So that probably gives some room for monetary easing. But if one looks at the future, then possibly there are lots of inflationary pressures that are building in the system. So whether the central bank will wait to see how those ramifications get built in is a difficult call. So we are still maintaining a 25 basis point rate cut view, but with less amount of conviction.
And finally, how do you think the government is, or rather the finance ministry is going to go about addressing the liquidity issues? Do you think another CRR cut is in the pipeline, or do you think it is going to be through the OMO route?
See, the way we are looking at it is that the government is right now sitting on a huge cash surplus of more than 1 lakh crores. This money is going to be partly spent for the year-end spending and partly for redemption purposes in the first week of April. Once this money comes back into the system, probably the liquidity situation will look much more comfortable. We expect this number, liquidity deficit number, to fall below 1 lakh crore by mid of April. If that happens, then possibly in April we will not require any kind of liquidity infusion measures from RBI. As we move along the year, possibly OMOs will be required, but to a large extent, the OMOs as well as CRR combination, this will be a function of how much intervention RBI has to do on the currency market, because that's a big source of drainage of liquidity. So OMO is expected. The timing is at this time a very hard call.
Fair enough, Samir. We leave it at that. Thanks very much for joining us this morning and giving us your perspective on the government's borrowing program.